So we're going to go ahead and get started here. And I would just ask that as we kind of go through this, if you're not a presenter, that you keep yourself on mute if you are not already. And if you have specific questions for any of our panelists as we move forward, you can either unmute yourself and ask those, or you can use the chat box function, and we'll make sure that we pause in between each speaker for time for questions. So for those of you that don't know me, I'm Katie Eaton. I'm the president of the Michigan City Chamber of Commerce. Thank you so much for joining us this morning for our Navigating Uncertainty and looking at steps towards financial security for your business, especially in these uncertain times. So we're going to cover some topics around small business financing options, employee tax credits, and of course, PPP loan forgiveness application process. And I want to thank our partners on this, First Merchants Bank, who came to me a few weeks ago and said, hey, we want to do something to get some information out there, and they helped really coordinate our speakers for today. So thank you so much to First Merchants Bank for helping us out with that. We have Nicole Zell with us with the Regional Development Company as one of our speakers. She'll be up first, and she will have to jump off the call at some point, so we'll make sure we pause for some questions after she's done speaking. We have Eric Jaski with Blue & Company, and then Tammy Pay with First Merchants Bank. And then of course, I'll kind of moderate questions as we move through the presentation today. So up first, we have Nicole Zell. She's the Vice President of Lending with Regional Development Company, and I will just kind of hand it right over to her and let her jump into her presentation there.
All right, thank you, Katie, for putting this together. We have been, obviously, we work with small business owners throughout the region and into Illinois, and we've been trying to do everything that we can do to help out in any way we can during the pandemic. Hold on a second, sorry. So one of the options that we have right now is the SBA 504 debt refi program. So I just wanted to go over the program for everybody, and if it is an option for you and your business, it is a great way to refinance your debt, lower your monthly payments if you have an existing commercial loan, and get some cash out for working expenses. Do I have the option to move? Okay, there we go.
Yep, you can just let me know when to go to the next slide.
Okay, okay. So the debt refi program was developed to improve cash flow and maintain day-to-day operations. The benefits of this program is if you have an existing commercial real estate mortgage, you can re-amortize that mortgage over 25 years. And I just realized I have monthly instead of monthly on there. Sorry about that. And you are eligible to take out cash for business expenses. There are some rules. We do need an appraisal on your commercial real estate to determine the equity in the real estate and the available, or the money that's available for cash out. So I think on the next slide, I have the information about, oh, okay. Well, the 25-year fixed rate right now, this is locked in for 25 years on the SBA 504 portion. And the rate that we locked in for the loans that funded in June of 2020 was 2.603. The banks, I think right now are around 4%. And right now with the economic uncertainty, I know banks rates are, they're going to change, they're going to go up and down. We work with the bank and give our small business owners the option to fix at least a portion of their loan for up to 25 years. And then on the next slide. So how do you qualify to take advantage of this program? If your business has been in operation for at least 2 years, your business also has to occupy the real estate that you are wanting to refinance. So we cannot do investment properties, so no apartment buildings or anything like that. But if you have a building, we have a lot of borrowers that have buildings in downtown Michigan City where maybe they have apartments or their businesses on the first floor, maybe apartments on the second floor or third floor. As long as your business occupies 51% or more, you would qualify for the 504 debt refi program. And the real estate has to be commercial property, no residential property. Or residential property is not eligible. Even if you operate your business out of it, it has to be considered commercial property. And on the next slide, the loan has to be entered into a minimum of 2 years ago. If you have a loan that is maybe 10 years old, but you refinanced it less than 2 years ago, that will still be okay. Your loan also has to have been current for the past 12 months. The SBA considers that your loan is current if you have not made any payments over 30 days past due. They do take into consideration, I know there's a lot of small business owners out there that maybe have had a deferment or some kind of modification on their mortgage. As long as you have a written agreement with your lender and you followed that agreement, you would still qualify for the 504 debt refi. Oh,
sorry.
And also the mortgage to refinance has to have originally been used to purchase or improve commercial real estate. We can't refinance a loan, say that you took a mortgage out on your commercial building, but used that money to buy, some other building. That would make the loan ineligible, but as long as it was used to purchase or improve the commercial real estate, then we can use the program. And we unfortunately cannot refi any loans that are currently backed by the government. So any SBA loan, a 7A loan, an existing 504 loan, and any USDA loans, unfortunately, are not eligible for the program. So that was just a quick overview of the debt refi program and the requirements. And so if anybody has any questions, I would be more than happy to answer them. And if you have any questions after the presentation, since I'm going to have to jump off the call about 9:30, I am sure Katie can get my contact information over to everybody.
Yes, so if there's any questions for Nicole right now, you can either unmute yourself or you can use the chat box before we move on. And like Nicole said, we will definitely be sending this presentation along with the recording of this session out to everyone that is participating today, and also to anyone that was not able to make it. All of the contact information is in there. So if you have specific questions you want to follow up with Nicole later, you can definitely do that. Any questions right now for Nicole?
All right.
All right. Well, we will jump on then to our next speaker. Eric Jaske is the director with Blue & Company, and he's going to talk a little bit about some of the different tax credits. So I'll hand it over to you, Eric.
Katie, thank you. I appreciate the opportunity Katie, to speak to the Michigan City Chamber today. I appreciate First Merchants asking for Blue's involvement. I'm a native of Michigan City. My wife and I are born and raised in Michigan City, so it's good to give back to the Chamber. We live down in Fishers, Indiana now, but we are back up north often. So for those that do not know much about Blue & Company, we're a regional size CPA firm. We are a top 60 firm in the country. We've got offices in Indiana, Kentucky, and Ohio. We're about 500, almost 500 total employees with about 50 directors and or partners, directors we call them in our offices. So again, appreciate the opportunity for First Merchants to invite us to present today and just kind of discuss some of the things that we're seeing and talking about with our clients since the pandemic has started, and we've kind of gone through this remote work environment. Clients' operations may have slowed down sometimes since probably the beginning to mid-March. Now we're almost 3 months in to kind of, I wouldn't say we're completely shut down. I know the state of Indiana is opening up slowly but surely on the governor's plan, and hoping to be reopened almost fully here towards the end of the summer. And so what does that mean? What have we been talking to our clients about? What are some of the common questions we've been having? Which on the slide, it's the biggest thing we've been talking to clients about over the past 2 to 3 months is been cash flow management. And, monitoring those receivables, are you billing timely? Are you advance billing? Are you making sure your AR department is keeping an eye on receivables so they don't go out 60, 90, 120, 150 days? That's one piece. How are we structuring our payables? I've got some clients who were paying their payables, their operating payables in 15, 20 days. Well, did it make sense to pay those in 30, 45, or 60 days to free up some liquidity and some cash flow within the business during this time? We talked about deferring unnecessary capital expenditures. What do you need here in 2020 from a CapEx perspective? What can be pushed out to 2021 and beyond? Where is our debt service going to be on any CapEx expenditures versus what we need to expend cash on? Hiring freezes and monitoring employee headcounts has been big. We have got a lot of clients who have either froze hires or may have been in a position where they've had to furlough some employees or lay employees off. Tammy, in the next presentation slides, will discuss the Paycheck Protection Program. Well, there's a lot of monitoring the employee headcounts as it relates to the forgiveness calculations that I'm sure Tammy will discuss in her part of the presentation. So that's been a key component of what we're looking at and forecasting and budgeting on. Also, lastly, just regularly monitoring your pipeline. I spent a lot of my time in our construction and real estate practice. And so our clients are looking at backlogs. What's on the books? What are we working through right now? How many bids are coming up in the next 3 to 6 months? Can we rebuild some of the backlog we have? Our manufacturing group and distribution group is talking to a lot of their clients regarding their customers. What's their customers' projections for the upcoming year? Are we going to have a pipeline of work so we can keep people busy? We can keep the business operational, keep things moving, so on and so forth. So cash flow management, again, is the key piece that we've been talking about the past couple months with our clients. And we've really stressed our clients to push on a 3, a 6, a 9, and a 12-month cash flow analysis, meaning, and then stress test that. Let's say we've got AR that we typically get in a 30 to 60-day period. Well, what if that AR gets stretched to 120, 150 days? What does that mean for liquidity, cash flow management? What does that mean for the business? Can I continue to operate? So on and so forth, pay employees. How does that look? Stress test it. We've stress tested a lot of cash flow models in terms of, well, what if our total revenue's down, 10, 20, or 30% from our 2019 or 2018 activity? What does that do to our overall cash flow needs? So that's been one key component of our discussions. In addition to, again, as Tammy will probably discuss in the Paycheck Protection Program part of this seminar, that piece has been key in terms of when you fill out your application. And there's been a lot of, there's been a lot of media attention drawn to those loans that are in excess of $2 million are going to be looked at and reviewed. Whether it's 3, 4, 5 years down the road, the SBA is going to look at those. They've indicated they're going to look at those loans. Well, having this kind of cash flow plan, stress testing the plan, I think provides some pretty adequate documentation on whether you did or did not need the funds that you received from the P3 program. In addition, we've advised our clients to draft memos, narratives on during the P3 program period, why they needed the funds, what was the intention of them, how they were going to use them, what they did on the stress test cash flow modeling plans, so on and so forth. So again, working with your advisors and your lenders on those areas has been a key discussion point over the past couple months. Now, as far as the FFCRA and the CARES Act goes, is the employee tax credit, deferment of payroll tax liabilities, providing some additional cash flow from the deferment of payment of Social Security taxes or some employee retention credit opportunities you have out there. The Families First Coronavirus Response Act, which was signed into law middle of March of 2020, required that certain employers provide employees with paid sick leave or expanded family medical leave for specified reasons related to the COVID-19 pandemic. The act provided that employees of these covered employers are eligible for 2 weeks or up to 80 hours of paid sick leave at the employee's regular rate of pay if the employee was unable to work because of the employee was quarantined and or was experiencing COVID-19 symptoms. So regular rate of pay, which was going to be capped at $511 per day. Or you've got 2 weeks of paid sick leave at 2/3 of the employee's regular rate of pay if that employee was unable to work because of a bona fide need to care for an individual who is subject to quarantine, or care for children whose school and or childcare provider is closed or unavailable due to the reasons related to the COVID-19 pandemic. In addition to that, there was also an additional 10 weeks of paid expended family medical leave at 2/3 of the employee's regular rate of pay for an employee who's at least been employed for 30 calendar days, but was unable to work because of child care provider was closed or school was closed related to the pandemic. So, and that was capped at $200, 2/3 of pay or $200 per day. We're going to see a lot of this here come, and this was enacted 15 days after enactment was signed, which started on April 1st of 2020. Our Q2 payroll filings are going to be coming due in July, our Form 941s. I think that's where you're going to see a lot of these credits be taken when you file your Q2 payroll forms. What we've noticed is a lot of the payroll providers in our market, and I'm sure in the Northwest Indiana market, have been on top of this in assisting clients on the calculations, the documentation required to support the credits they're going to receive, and have had some employee and employer dashboards to capture this information. So that's been a topic of our discussions. In addition to that, we've had the CARES Act that was signed into law late March of 2020 by President Trump. And two main topics of our discussions there as far as the credits have gone and were the employee retention credits and the delayed payment of employer payroll taxes. So the employee retention credit, as part of the CARES Act, is a refundable tax credit against certain employment taxes that are equal to 50% of the qualified wages an eligible employer pays to employees after March 12th of 2020 and before January 1 of 2021. So in addition, eligible employers can get immediate access to the credits by reducing their employment tax deposits that otherwise are required to be made on maybe a semi-monthly basis or monthly basis. For each employee, wages including certain health plan costs up to $10,000 can be counted to determine the amount of the 50% credit. The 50% credit, therefore, is capped at $5,000 per employee. And this credit can apply to wages already paid after March 12th, and employers do have an opportunity to request an advance credit from the Internal Revenue Service by filing a Form 7200. We haven't seen too many clients file the Form 7200 who have taken advantage of this employee retention credit. What we're going to see is many of those businesses are going to take this credit on their Q2 Form 941. So employers are eligible for the credit if they operate a trade or business during the calendar year 2020 and experience either a full or partial suspension of the operations of their trade or business during the calendar quarter because of governmental orders that would limit your commerce, your travel, any group meetings, so on and so forth. Or what we've seen the most of is a significant decline in gross receipts. That significant decline in gross receipts begins on the first day of the calendar quarter in 2020, for which an employer's gross receipts are less than 50% of its gross receipts for the same calendar quarter in 2019. So that's kind of been the threshold and the test we've seen some of our clients who've been able to take advantage of this retention credit have. That decline in gross receipts ends on the first day of the first calendar quarter following the calendar quarter in which the gross receipts are more than 80% of its gross receipts for the same calendar quarter in 19. So you got to kind of have some projections and monitor where you are in the process. If you've maximized the credits, if you've not, when you're going to trip that gross receipts threshold. One key piece of the employee retention credit is that if an employer receives a loan under the Paycheck Protection Program, then the employer is not eligible for the employee retention credit. So it's one or the other. We've only had a couple clients who have, that I've seen, businesses who have taken advantage of the employee retention credit. Most of our client base and the businesses we've worked with have mostly all gone after the Paycheck Protection Program, simply for cash flow needs and the amount of the loans. The second piece of the CARES Act was related to the deferment or the delayed payment of the employer payroll taxes. The CARES Act had allowed employers and self-employed individuals to defer the payment of the employer's share of its employees' payroll taxes. The provision in the CARES Act required that the deferred employment taxes paid, the deferment of those employer taxes would be paid at 50% of that payment would be due on December 31st, 2021, and the other 50% would be due at December 31st, 2022. Therefore, from April through the end of 2020, you've got an opportunity to defer the employer's portion of the payroll taxes, Social Security taxes, and keep the cash and have an opportunity on an interest-free loan, interest-free, non-penalty based, and pay 50% of that amount back at December 31st, 2021, and 50% back at December 31st, 2022. Originally, as part of the CARES Act, the Paycheck Protection Program loan borrowers whose loans would subsequently be forgiven were specifically precluded from taking advantage of this deferral in the CARES Act. But the Paycheck Protection Program Flexibility Act that was signed into law on June 5th of 2020, earlier this month, retroactively eliminated that provision. And so now P3 borrowers who have loan proceeds forgiven are now allowed to use this deferral mechanism. So a little bit of a change in the law, taxpayer friendly, business friendly, gets more cash into the hands of our businesses to work through this pandemic whenever this is going to break. So two other key pieces that have been hot topics, I believe, in our discussions as far as the CARES Act go are the net operating loss modifications and the qualified improvement property correction. The Tax Cuts and Jobs Act of 2017 that was signed into law in December of 2017 required that any net operating losses for C Corps or individuals that would be sustained after 12/31/17, so 2018 and beyond, would no longer be allowed to be carried back. The rule was you could carry back 2 years or carry forward 20. The CARES Act now removed that limitation and is now allowing C Corps and individuals who have net operating losses that were in place in 2018, could be in place in 2019 and 2020, an election to carry that back 5 years and apply for refunds during those years. So any business or individual who's considering doing that should work with their advisors and their counsel just to determine, is that the most optimal way to use my net operating loss? If I go back to a 2013, 2014, maybe a 2015 year, am I getting top marginal rates when the tax rates were higher in those years than they are now? So you've got to do some sort of analysis to determine, if I go back, am I going to get higher tax rates than I would now? Or if I project out my utilization of that net operating loss, if I elect not to carry it back and I elect to carry it forward, am I better off carrying it forward at rates at today's rate structure, depending on projections? So key analysis to do and evaluate when you're looking at net operating losses. Also, the Qualified Improvement Property Correction, the Tax Cuts and Jobs Act, that was again signed into law in December of 2017, had a what many practitioners would call a technical glitch in it, where qualified improvement property was 39-year property, basically interior improvements to a non-residential building. That improvement property was 39-year property, not eligible for what's called 100% bonus depreciation, immediate expensing elections. Practitioners thought, well, in the rush of getting the Tax Cuts and Jobs Act passed through Congress, everything documented, there was a glitch in it that the intention was to make the qualified improvement property 15-year property, which therefore would be eligible for bonus depreciation, 100% expensing election. And so the CARES Act corrected that technical glitch in the law and retroactively put it back to 2018. So now an analysis can be done in your business if you've had qualified improvement property in 2018, especially in 2018 if you filed your returns timely, even including on extension. If you use 39-year property for that qualified improvement property, if you've not filed your 2019 return yet, you can either catch up the deductions on the 2019 return, or you can go back and amend the 18 return. So there's some opportunity there again, as Congress is trying to free up cash availability and liquidity for businesses. There's an opportunity to amend or catch up those additional deductions based on this correction for the qualified improvement property, for taxpayers to get more cash, businesses to have more cash in their business for liquidity purposes. So that's been an analysis we've done as well on what makes sense, amending or just catching up the deduction in the current year. And lastly, of course, probably the biggest piece of the CARES Act, which I know Tammy will go into great detail on, which, God bless her, it's been a moving target for 2+ months. I feel bad for the lenders who have had to work through this process. I know it seems like every week the program is changing. SBA sends out new information regarding the program. So many of our clients have taken advantage of the Paycheck Protection Program. And I know, again, Tammy will go into greater detail on it. But the one thing I just wanted to note on that is we are stressing to our clients to, again, back to my original slide, talking about the cash flow management, making sure you have kind of those cash flow models done, supporting the need for the Paycheck Protection Program loan, and having the narrative written out where 3-4 years from now, if the SBA does come in and review your loan application, your forgiveness application, you've got the documentation to support. You don't have to go back 3-4 years. You've got it in your file supporting the reason why you needed the funds, why you applied, you stress tested your cash flow model, and it kind of supports the reason and the certification you made on your original application saying you needed the funds. So if you have any questions or comments, my email or phone number is on the slides here. I'd be happy to address anything I could, but if not, I'm more than happy to hand it off to Tammy, and she can explain the further details of the program.
Thank you, Eric. Yeah, we'll go ahead and move on to Tammy, and unless there's any specific questions for Eric right now, but we will have time for questions at the end as well. So, Tammy?
All right, wonderful. So this is the partnership that you guys are all really looking forward to. As Eric alluded to, there's been a lot of moving pieces and a lot of changes that have been made to the PPP program over the last 3 months as we worked from start to now what we're getting into is the forgiveness piece. So the first slide that I have for you, there were some changes made to the program as of June 5th. So if you received the PPP loan prior to that date, this is what you will be subject to. I tried to lay this slide out so that the talking points mirrored up exactly to the changes. So under the original terms and conditions of that loan, you are given basically an 8-week period to spend the money on payroll, rent, or mortgage interest and utilities. So the allowable expenses under that program. Under the new changes, you are given the option of choosing either 8 or a 24-week period that would be considered a covered period, or December 31st, whichever is first. There have been some changes since the slide presentation was put together last week, and while it says up to 24 weeks, there has been clarification that you have to choose either 8 or 24 weeks to make it uniform for everybody. The words of up to in there is a little bit misleading, so I want to make sure you do know that it is either 8 or 24 weeks that you choose. The other piece that was changed was previously you were required to use 75% of the PPP fund towards payroll. They have since reduced that to 60% of that, and for now we'll get into the calculation of how to look at that 60%. And then the third bullet point is because that 8-week period was essentially going to end on June 30th under the original program, you were required then to rehire employees at their existing compensation level by June 30th. Now under the 24-week option, you have until December 31st to do so. So those are the primary changes that impact those clients who have had PPP loans prior to June 5th. The next slide talks about payroll amounts for those employees that are capped at $100,000 on an annualized basis. And there's a difference in the calculation of the 8-week period on the left side of the screen versus if you are going to use the 24-week. You have to see some additional guidance. It does not appear that this cap of $100,000 is going to be eliminated. It does sound that that is going to continue with any forgiveness application. So keep that in mind. It does allow you to do a little bit more in terms of funds that go using a 24 weeks. So it's almost a difference of about $30,000 on an annualized basis. The next slide talks about the end loan. Again, these are for loans that were approved prior to June 5th. So for those that have a PPP loan where not the full amount is going to be able to be forgiven, your end loan will remain structured as a 24 months at 1%. The first 6 months will be interest only, and then followed by an 18-month amortization. You can prepay the loan at any point during the 24-month period. All of the prepayment penalties are removed. I will note that if you really don't feel like you're going to be able to put all the payroll that you applied for within that 8-week period, I strongly suggest that you choose the 24-week option. The reason behind allowing 24 weeks by the SBA was to pretty much all that ensure and guarantee that the full loan amount would be forgiven. So strongly encourage you to look at going 24 months if you really feel that you're not going to hit the 8 weeks. The last point is somewhat of a recent change, but it is a little bit more of a clarification. So borrowers on the PPP loan actually have 10 months to submit their application to the bank following the end date of either the 8 or 24-week covered period, as we call it. So if your end loan ends, say at the end of the year, you have until basically October of next year to submit that application to the bank if you want to be granted forgiveness. If you choose not to submit an application during that time frame, the principal and interest will start almost immediately on the full amount. So keep in mind there is a little bit of time that you have to get the documentation needed along with the application in order to submit that to the bank. So those setting points all for loans approved before June 5th. As Eric noted, and as I've mentioned here a couple of times, that there were significant changes to the program as of June 5th. And it's for all of those loans that were either applied for or get approval on June 5th. There is no choice for these as to whether you 8 or 24 weeks. It will automatically be 24 weeks. And for forgiveness starts the day that loan is dispersed or December 31st, whichever comes first. In theory, if you're doing the math, if you've got a loan on the 30th, which is the last date the loan program will be in place, your 24 weeks is essentially December 31st. So depending on where you fall within that, it will dictate when your forgiveness clock can start. So the biggest difference in the end loan for PPP loans approved after June 5th is that the end loan will be based on the 60-month amortization and not the 18 months for the original loan program. The one thing is that it is at the discretion of the lender as to whether to extend the loans prior under the original program from the 18 months to 60 months. So that's to be approved by both the lender and the borrower and agreed to. In theory, you know, if you were under that program and you elect this 24 weeks, there should, in general terms, there should be no reason why you would have an loan. It gives you 3 times the amount of time for what you need for in order to use those proceeds. So it should help with the need to have a loan, and then really no need to stretch it out for 60 months. We really want to get this off the book through a month for us, because normal operations and traditional lending, we don't want to have this be a legacy on your sheet. So the next slide is going to speak to the math behind the 60%. Just because you may not use all of the money at a 60% level does not mean you cannot apply for forgiveness. It just means that your loan amount may be decreased for that. So using the example I have here, if you applied for a $150,000 loan and spent $75,000 on payroll costs, doing the math, that's about 50%. But in order to determine the max loan amount, you would take the amount that you spent on payroll and divide that by 0.60. And that will get you the full loan amount that you would be eligible to apply for. In this case, the 50% equates to $125,000 out of the $150,000, and then you would have to have the documentation behind the remaining $50,000, so $125,975. You have an additional $50,000 in eligible expenses, which includes rent, mortgage interest, I forget what the other ones are. So utilities. And we'll speak to those on the next slide. There's an outline of what other eligible expenses are there. So that's how you calculate the 60% of your loan amount. So then next slide talks about the non-payroll expenses. When it started, the last bullet point is really what I will draw your attention to. When the program first started, it just basically said utilities, and it didn't outline what specific utilities could be included in that. We've since received clarification that it does include electric, gas, water, transportation, telephone, and or internet expenses. Now, whether you include interest payments on a mortgage, whether you include rent expense or any of these utility payments, all of the leases in place must have started and been in agreement before February 15th. You cannot repay on any principal related to the mortgage in order to allow that to count, but you may potentially be asked for a lease agreement. So if you are starting to consider this as part of your forgiveness loan amount, I would gather those lease agreements, because I'm pretty much guaranteed I'll be asked for this for confirmation. The next slide talks about the forgiveness application, and this is the key part as to what has changed last week. About 2-3 weeks ago, the SBA released the original version of what they call Form 3508, which is the forgiveness application. Last Thursday, late in the afternoon, they also released not only an updated version of the 3508, but then they also created a streamlined version called the EZ form, where you are self-employed, sole prop, or an independent contractor, so 1099 with no true employees, you can use the EZ form. If you've maintained salaries and have not had a significant reduction in hours or in the number of employees, you can also use this form. And then the other one is for doctor's offices and dentists where you have not been able to open or operate within due to COVID. So those are the 3 types of loans that can be used on the EZ form. So the difference between the 2, I think the EZ form is of 1 or 2 pages, and then the 3508 is around 10 pages, I believe. So certainly something to keep in mind that, you know, it should help eliminate any questions or help provide instructions in that manner. The next page is linked, and we'll I'll ask Katie to make these links available to all of the participants here. These are the links to the forgiveness application. They're found on both the SBA website as well as the Treasury.gov website. Also included on that page with it are instructions. The SBA has done a great job on the forgiveness application piece, which we've realized from the original application, we needed a set of instructions to make sure that we were all looking in the same manner and have put that together for us. There's about 3 or 4 pages in it, literally outlined line by line what to look for, how to calculate. And so I strongly encourage you that as you start to go out to either one of these sites, that you also link the instructions just to help give you a sense for what they're looking for. Again, we'll make those available to you so that all you have to do is click on it to find it. So what are the next steps for you as a borrower under the PPP loan program? We have the forgiveness application and we have the easy form. What we don't have at this point is how lenders are going to be able to submit their application to the SBA. When the loans were originally approved, we went through their A-Tran system, and we're anticipating it's going to be very similar to that. But at this point, we don't have concrete instructions on how exactly to submit the forgiveness to the SBA in order to receive payment. So I'm ready to get going. I know you guys want this behind us, as do we, but just please be patient. We are working diligently behind the scenes to get that detail for you. Second bullet here is, and this is why I stress the patient piece of it, it could very well be up to 5 months before the loan is actually forgiven. So once you submit your forgiveness application to the bank then has 60 days from receipt of the date of the completed application. So if you're missing any information, that does not count as a completed application. But we have 60 days from that date to submit the package to the SBA. SBA then has 90 days to review it and submit payment back. So in theory, it could be, worst case scenario, it could be after 5 months before the loan is truly forgiven. This is one of the tricky things where, we want you guys to be prepared, but without having full guidance, knowing that that clock starts the day that we have the information, we don't want to put you in a fire drill or us in a fire drill situation and create any issues for you and potential non-forgiveness of the loan by accepting these applications prematurely. So that's why I strongly encourage all my clients, just start documenting, start getting the file together. Too much is never enough when it comes to government loans. So just be patient with us as we start to work through that. I will say that I put this presentation together last week, and as Eric mentioned, the situation continues to be fluid. It changes almost by the hour. So do not be surprised if anything that we present today changes in the next couple days as we start to move within this last week of the PPP program. And speaking of patience, the last slide that I wanted to share with you is this is the summary across the United States of the number of loans that were done as of June 17th. There were 4.6 million approved loans for $513 billion. When you think about, you have one loan, but how many this equates to across the United States in a new program that none of us have done before, it's pretty amazing to see what has happened. My first website this morning, and the update as of last night is there were 4.675, so we've done about 50,000, 55,000 new applications in just the last, 5 days, for $515 billion. It's about $1.8 billion that has gone out in PPP loans over the last 4 business days. Pretty incredible when you think about, the number of businesses across the United States and what continues to still be done and the impact of coming this far into the program. So I'm kind of a numbers geek, so when I look at this, it gives me a little bit of chills knowing that we participated in this, you guys participated in this, and it's pretty amazing to see how quickly it all came together. So that's all I have on my piece of the presentation. Happy to open it up to questions.
Yes, thank you so much, Tammy. So we'll open it up. That's the end of our presenters. So if there's specific questions, Nicole Zell has jumped off the call. As she mentioned earlier, she had another call that she needed to get on this morning, but Tammy and Eric are still with us. If you have specific questions for them, you can unmute yourself and ask those now. Or if you feel more comfortable, you can type it into the chat option. If not, as we mentioned, this recording will be available afterward to everyone here, as well as those that were not able to be on the call this morning. And we will share that with you along with those links and the presentation. Everybody that's on the call, we'll send that out via email to everyone. Any questions at this time? Doesn't sound like it. You guys must have been very thorough. So that's good. I'll just ask, Tammy or Eric, if there's anything additional that you want to add before we close out.
Don't hesitate to reach out to your banker with any questions. My contact information is within the slide presentation. I'm happy to answer what I can.
Okay, thank you. Eric?
No, just want to thank you, Katie, and Janelle again for hosting this, and the Michigan City Chamber of Commerce for inviting Blue & Company to be part of it, and Tammy and First Merchants for inviting us as well again. So thank you. I appreciate it.
You're welcome. Thank you so much to all of our presenters. Again, thank you to First Merchants Bank for organizing this. I think Kelly Blyden has joined the call as well. She's on here. She was kind of helped us get that organized along with Chris Chatfield. So thank you so much. If you need to get a hold of us for anything, our contact information is on here as well. If there's other questions that you have or other topics that you would like us to cover in a session like this, please let us know. We're happy to organize these and put them together for our business community. Thank you so much again for everyone joining us, and have a pleasant day. Bye, everyone.